Welcome back for our part two of the Tale of Weston. And now we add Captain Accounting. I again am joined by a lover of these kinds of stories. Art has joined us to make sure I don't go off the rails. But nonetheless, Art's with us and make sure that I'm telling the story in a way that helps solve some questions that might be out there. So anyway, we left off when Weston was going through and was learning about prime costs and conversion costs. So we know about those things. These two were prime. These two were conversion. Note, direct labor is the only one that gets into both categories. It's very special. But the question was, will Weston have enough to actually make a profit? And so that's the challenge. So here's the question. Okay, what do you think Weston will charge for his hot dog on the corner in New York City? Well, he has an idea that it'll be $3. That it'll be $3. Well, what does that make you think of, Art?
That makes you think of how much money he might be able to make. So his profit.
So that's the plot twist, right? Because we've been talking about this idea of product costs. But remember, we're only interested in the product cost because we're trying to compare it to the price we can get for the product we're selling. So we have an idea if we are able to compete in the market or perhaps even whether our sale price is too low. One of the things we do know about hot dogs in New York, about the max you can charge is $3. So especially for Dull Dogs LLC, 3 may be a little high, but nonetheless, you're trying to match the costs with how much you can sell it for. As we move on, there's a couple of terms that Weston needs to know at this point. Weston needs to be aware that there are three kinds of inventory: raw materials, work in process, finished goods. You have any questions about those, Art? What constitutes each one?
I think raw materials is just your hot dog and bun, right?
Yep. So that's the hot dogs and buns that Weston has to purchase. And you might remember that term purchase is going to be really important to you later on. Hey, what's the work in process here?
That is a good question. I don't know that one.
Well, work in process is going to be the product that you're making that at the end of a period, you may not have finished it yet. So if I think about a day in Weston's world, the idea being that, okay, at the start of the day, I probably don't have any hot dogs and buns ready to make. At the end of the day, hopefully, Weston doesn't have any either. There really shouldn't be any hot dogs still in process. So probably there's no beginning and no ending work in process inventory for a street vendor of hot dogs. So that's one thing as a customer you kind of need to focus on. All right. Finished goods. Any hot dog, in this case, one of the things we know is that Weston has this plan to freeze unsold dogs. So any frozen hot dogs at the end of a period, Weston's going to use those and sell those in small packages to convenience stores. Then they can put them on that little thing that goes around.
Right.
It pretends like they're cooking. All right. The next thing that we need to know is an inventory equation. And this is the way I set it up. We got some beginning inventory, or I call it beginning stuff. We're going to add to that. Eventually, there's going to be stuff that's coming out of inventory. And then we have some ending stuff that's whatever's left over at the end of a period. Now, the timing of those things can be challenging. And so that's why Captain Accounting comes in here and says, you need to think about inventory on a timeline. Think about the beginning of the month, the start of the month, and the end. And throughout this period, we're probably buying hot dogs and buns. But also throughout the period, we're selling hot dogs and buns. So at the end of the period, we need to think about, will there be a match between what I bought and what I used? And so we've got the purchased versus the used. And so if we purchased more than we use, our ending inventory is going to go up. If we use more than we purchased, we'd better have some beginning inventory because we're going to use that to meet the difference. Does that communicate, Art?
Yes, so you can only take inventory at any one point in time, right?
Oh, yeah, that's right. So this is really important. This is really important. So remember, inventory is points in time. Everything that happens in here turns out to be over a period of time. This is why the information going on in here tends to be an income statement.
Okay.
And these pieces tend to be balance sheets.
Gotcha.
I'm not going to harp on that a lot, but that's a connection back to the other accounting superhero, Christine Smith, and the work that she does in anonymity out there somewhere in a lecture hall at Tulane. But nonetheless, those are the pieces that she would talk about quite a bit, I suspect. So at that point, Art, we need to go over and take a look at our spreadsheet and think about this business that Weston's trying to create and how that might show up in this cost flow worksheet.
Perfect.
So we've got some facts. So at the start of the period or throughout the period, Weston bought $5,000 of hot dogs and buns. Okay. Weston paid $3,500. Weston received payroll or labor costs of $3,500. Tell me again why the best life that Weston's living, why does Weston need $3,500?
Because he lives in New York City and he needs to survive.
There's rent, there's utilities, he might want to eat.
Maybe.
So probably $3,500 will get him into someone's closet. All right. So, whatever. You live where you want to, and that's how Weston's making it happen. Now, Weston also has some overhead. Weston, for the business, would pay rent, shall we say, on the cart that they have, maybe utilities or propane costs, condiment costs, and those would fit into overhead. Okay, one of the reasons condiments would be overhead is because Weston doesn't really want to keep track of all the little things of ketchup and mustard and whatever. So they're just going to consider those part of the overhead. Beginning inventories, in this case, all the beginning inventories are going to be zero. And the reason is that Weston is just getting started. So all the inventories start at zero. They all start at zero. So that's why we're here. Okay. If you've got a company that's been going for a while, they won't be zero beginning inventories. Okay. But as Weston's getting started, he has to start from the ground up. So there's nothing there. At the end, we've got some ending inventories. Make sure you distinguish between the inventories for raw material, work in process, and finished goods. The other thing to be aware of is during this time period, during the first month, we'll say, Weston was able to produce 4,000 dogs. Weston only sold 3,600. Now that's going to tell us something here shortly, but remember you're distinguishing between the units and the dollars. So be a little careful. Now the other day I was asked about that and I said, well, we're really following the dollars. In this case, it may be helpful to see how the units are reflected in the dollars. And then finally, yeah, we talked about the freezers and the small packages, and Weston is still trying to sell these hot dogs for $3. So that's where we are right now. So Art, if we're going to go through this process, we need to think about how it goes through our cost flow worksheet. So there are our three inventories. This is nothing more than our inventory equation. Beginning stuff plus the additions is equal to the ending stuff plus the stuff transferred out. These two things always have to equal these two things. It's a rule. It's a rule. And so you might remember, if you have 3 of the 4, you can always get the 4th one. So that's the missing data part. Okay. And so one of the phrases we used up here on the top, Art, was Weston purchased 5,000 in hot dogs and buns.
Yep.
Purchases is a very special word. So where do purchases go?
Raw materials, and it's what you add.
Okay. So the key here is it gets added to my inventory. And at this point, what Weston can do is throughout the month, because of these purchases, Weston now has enough dogs and buns to be able to produce the final hot dog, the finished dog that his customers need, or they go into his freezer at the end. Okay. Then you were told that at the end of this month, we had $1,200 in hot dogs and buns still in Weston's freezer in the apartment that's being rented. Okay, so we got $1,200 in hot dogs and buns that are taking up space in a freezer somewhere. Okay, so if I know that, Art, what was the cost? What was the cost of the hot dogs and buns that were used to satisfy customers' needs?
It would be 5,000 minus 1,200, so 3,800.
Okay, so that's going to be 3,800, and hopefully everybody sees how we got there. But just in case, the accounting Sherpa will now tell you again how this happened. So we had these two things. So we didn't have any inventory that could help us. We just had to start from scratch. So we bought $5,000 in buns and hot dogs. We found out when we looked at our what was left in the freezer at the end of the month, we still had $1,200 of hot dogs and buns left over that we can use at the start of the next accounting period. And as a result, we know the cost of the hot dogs and buns that were consumed in the production process, and that was $3,800. And we also know that swoosh, it goes into our production process. Now, Art, you remember we have a special name for this, right?
Oh dear.
That 3,800 is going to be called?
Direct material.
Yep, so that's direct material. The next thing you got to worry about is direct labor.
Direct labor.
And the next thing you got to worry about is manufacturing overhead. Those are the only 3 additions you can have to work in process, because those are the product costs.
Okay.
All right. And so you're told up above that we're paying, or in the details, you're told that we're paying Weston $3,500, and that Weston has overhead of $2,700. You're also told that because Weston every day sells all that is made, any inventory is going to be 0 when it comes to work in process. So this is almost always the most difficult of the inventory calculations. And so that's probably why you've come to see the accounting Sherpa today. All right, because as pointed out earlier, it's the beginning and the additions that get added together. So what Art's going to do is take that beginning inventory, even though it's 0, okay, and add to that the dum dull mo. Nothing's left over, so it's this amount has to equal this amount. So that's why this is 10,000. There's no effect because of inventory. There's no effect because of inventory. But you can see over here, though, in raw materials, there was an inventory effect, right? Because here we had some left over, so we had a difference in between what we purchased and what we used. Okay. Now the exciting part at this juncture is we get to do another swoosh. Those are always fun, always exciting, always worth extra partial credit. And so 10,000 comes over here. We were told that we had $1,000 in ending inventory. So the cost of the hot dogs that we sold was 9,000. All right. So let's think about these other two terms that we're introducing here. We got a COGM and a COGS. COGM is a very specific name, cost of goods manufactured. Okay, so it's the cost that we incurred to make the finished hot dogs and buns. Okay, not until we transfer it out of here do we consider it to be a finished hot dog and bun ready to be sold. Okay, once that came in here, the question is, what did we actually sell? Because we need to think about matching the cost with the revenue that we're generating. And so the cost of goods sold is the 9,000. Now, be careful, because the cost of goods manufactured is not the same thing as the cost of goods sold because of inventory effects. All right?
Yes.
Now, we were also told that we produced 4,000 hot dogs for sale, and we were told that we sold 3,600. So Art, how many hot dogs, finished hot dogs and bun with a bun, are sitting in Weston's freezer ready to be packaged and sent to convenience stores?
The 400 that are left over.
Okay, so we've still got 400 sitting here in the freezer, because if we produced 4,000, we sold to our street customers 3,600, I've still got this 400 frozen. And eventually, Weston will just have to let it go. Frozen joke. All right, so that's the setup we have. So Art, how would we think about this in terms of whether Weston's making any money?
To make money, you need your cost of goods to be less than what you're charging for the goods. So
Okay.
we find
So
out.
sales minus cost of goods sold is a measure of profit.
Yes.
Okay. And our cost of goods sold is 9,000.
Mm-hmm.
So what do you think our sales were?
We sold 4,000 hot dogs at $3 a
Oh,
piece.
but did we though?
Oh. No,
Ah,
we sold 3,600 hot dogs.
yes, we did. We sold 3,600. So be very, very careful, because this happens a lot. 3,600 is what we sold. We made 4,000. 3,600, and that, what did we sell them for?
$3 a piece.
So times the $3 each. And so if I can do my math right, I think that's 10,800 in sales.
I think so too.
So with that, Weston has generated a first month's profit of $1,800.
Yay.
So that's exactly right. And so that is the story of Weston, the hot dog vendor in New York City, and his now best friend and ally, Captain Accounting. So thank you for joining us. I hope you see now again why accounting is the root of all wonderfulness in business and in generally the world altogether. So with that, we're going to take a break, and we'll catch up with everybody a little later. Let's keep fighting the good fight. Take care.